Hi, I'm really excited to report today that I'm in Schroders' head office in the United Kingdom, and equally excited by the fact that I'm joined by Richard Buxton, who's head of their UK equity fund and also manages one of the country's leading flagship funds, the UK Alpha Plus Fund. Hello Richard.
Hello.
Now, we have a number of our clients invested in the Schroder UK Alpha Plus Fund, and we'll talk a little bit about that in a while. But I wanted to explore, first of all, your views on the passive versus active debate, because there are still people out there that are a little bit sceptical about a fund manager's ability to actually beat the stock market, and still a few supporters that think passive investment following something like the FTSE 100 gives the best possible long-term returns. So, how do you see the value in actively picking stocks as against the greater growth potential that you can get from what you do? Yes.
Well, it's still a very valid debate, because unfortunately, our industry in fund management, it hasn't always covered itself in glory, and there are sadly a number of funds. Either the manager changes frequently, or they do lag the index, reasonably persistently.
Yeah.
And therefore the attraction of an index, low-cost fund, is very real. On the other hand, though, both sort of instinctively you feel that passive fund management, tracking an index, it does mean that you're having more and more exposure to the shares that have gone up and got bigger and bigger,
Yes.
and less to the shares that have fallen.
Yeah.
Which is slightly counterintuitive to common sense. You
Yes.
want to be buying more of things that
Yes.
have perhaps performed poorly, and perhaps reducing exposure to some of the bigger things that have done well. We'll come on and talk about my fund, but it's nearly 10 years old, and in that 10-year period, it's delivered a return of 10.6% per annum against 6.7% per annum from the index.
Yeah.
Now that means that if you had invested £1,000 in the index tracking fund, that would now be worth 1,900. Terrific. My fund would be worth 2,700. So another £800 from your original £1,000 investment. That's pretty material.
Yeah,
So
absolutely.
clearly I can understand the issues on passive, but if you can identify managers that hopefully with the right team and analysts and so on that we have here at Schroders, can consistently add value, then I think my money's clearly still with active.
Absolutely, and so is mine, and so will our clients be too. So yes, as you mentioned earlier on, we're going to have the 10th anniversary in July of this year of the Schroder UK Alpha Plus Fund.
Having a party?
Yeah, I think a party, definitely. And you always talk about your best ideas approach in identifying stocks that make up the fund. Could you explain that a little bit more to our clients?
Well, yes, it's really our ideas of highest conviction. Where we really think that we have the opportunity over the medium to long term to really make money. When I set this fund up nearly 10 years ago, I'm afraid I did feel that the stock market for a number of years was essentially going to have good years and bad years, and good years and bad years, but broadly be going sideways. And that sadly has happened. And therefore I thought, again, if you had a very diversified portfolio, or indeed an index tracker, it's going to be up and down and up and down. Whereas focusing on your ideas of highest conviction and really building the portfolio around stocks, not around the index, would be the way to really try and add value. So we're looking at things always on a 3 to 5 year time horizon.
Yes.
We're very patient investors, we're very low turnover, we don't trade, we're genuinely slowly buying things for a multi-year period. But if we can identify companies where we think the stock market is undervaluing the future prospects of the company and the franchise, perhaps new management have gone in to improve a business, then as I say, we've got the conviction, and we'll build a portfolio of typically this fund that's only around 35 holdings. That's what we mean by high conviction and best ideas.
Okay, and you also mentioned that you look for absolute returns in situations. Can you explain that as well?
Yes, again, it's a phrase that has to be used with care, because there are absolute return products out there that will hedge market risk and that will try never to lose money and just always slowly go up. This fund doesn't involve hedging and so on. If the stock market goes down, this fund is likely to go down in the short term with it. But my absolute return approach, again, I'm looking at shares that I think can generate an absolute return over time, rather than merely outperform an index through a period of time. So I'm always looking at where's another 10 to 20% upside, and can I see it in my holdings within a reasonable time frame?
Yeah.
If you can't, then really you should be questioning, is it still an idea of highest conviction?
Is it still valid?
Absolutely.
Yes.
An example maybe, I mean, we were shareholders in Tesco for 7 years, but we sold them 18 months ago because we did just feel that it wasn't any longer an idea of high conviction. We couldn't see that future absolute return. We felt the business was actually beginning to struggle a little in the UK, and we weren't getting the comfort we wanted from management on that. So again, if it's not a best idea, sell it. Move on to your next idea of highest conviction where you can make an absolute return.
Yeah, I suppose that leads me on to my next question now, is that how do you track the performance of the stocks? How do you kind of keep up with what's going on?
A lot of what we do is very simply to monitoring. It is just keeping in touch with our companies. I think there's a perception that fund managers are constantly having new ideas and buying things and selling things and so on. Actually, I may only buy 2, 3, 4 new holdings a year. Less than that sometimes. So a lot of what we do is just monitoring. Is the company doing in profits and sales terms what we expected? If not, why not? Is the stock market beginning to rate and value that company more appropriately? We thought it was very cheap. So a lot of my day is spent meeting company management. That's absolutely critical. Spending time with my colleagues, the analysts, assessing the research reports that they write. We're trying to forecast out how we think the business could develop over the next several years.
I guess when you're meeting some of these company managers, you're having to read between the lines a little bit as well, aren't you, for what they're
Yes, it's interesting because some managers say, oh, there's no point meeting company management, they've all been to presentation training courses, and you'll never get to be able to. But you can read through the lines.
Yes.
Very genuinely, there are meetings where you can ask, how's this part of your business doing, knowing it's not doing terribly well, and people do go, oh, it's fine. But seriously, most managements they're pretty open, they're pretty honest, and if you do your homework with the report and accounts and results, you can identify areas that you do want to impress them on. But yes, you've got to be able to read a little bit between the lines, and also the merit of regularly meeting them, because you can compare and contrast what you said last time, how is the thing evolving and so on.
Sure, excellent. Yeah. And then, so finally, Richard, could you give us an overview of your current your top 5 holdings in the fund that you have?
5 holdings.
And from a fashion point of view, I do hope Burberry is still in
Burberry is very much still in there. Yes, Burberry, again, we've held Burberry for many, many years now. That's not to say that there aren't times that the prices have a very strong run and you may trim it a little, but conversely, it can fall and you can add to the position. But Burberry is still a top 5 position. The company has done extremely well in developing its brand. The international growth opportunities are still tremendous in terms of new store opening. They're getting into and developing new product areas. You've obviously identified in recent years, accessories, perfumes, and all sorts. And they've got such a massive following in Asia, and particularly China, that there's still enormous growth potential in that brand.
Yes.
So that's one of highest conviction. Taylor Wimpey, the house builder, has risen into the top 5 active positions by virtue of some pretty strong share price performance this year to date. We bought that 24 months ago on the basis that yes, the housing market is very sluggish, transactions are very low, but they are managing their business for margin, for profitability, not for volume of sales. Yes. And we felt that the market was just deeply undervaluing the future growth potential, the profitability, the asset value. So Taylor Wimpey is one. We talked about Virgin Media. Again, an investment we've had for 2 or 3 years now. But in essence, as you know, the industry has consolidated into really four main players: Virgin, Sky, BT, TalkTalk. And they have got the best, fastest fibre optic cable. And all the investment and the sunk cost has happened. There's only incremental amounts of further investment they need to do to keep it ahead of the pack. And yet, at the moment, as we know, the demand for broadband is just rising and accelerating. More and more homes needing more and more access because there's 2 or 3 PCs, there's a couple of televisions. So that's another one.
And let's hope you sound Bob can pull something out of the bag in a few weeks' time as well for them.
Yes, and Tate and Lyle is another top holding. Again, that's partly because we've held it a couple of years and it has performed very strongly during that time frame, and we've not yet taken any profits. And that was an example of a new management going into a poorly performing company, very radically seizing the business. They actually sold the original sugars business within 12 months of the new chief executive arriving. And they're focusing now on starches and, more importantly, food ingredients, higher value added, higher margin. As I said, the shares have performed well. We still think there's more upside in developing the food ingredients business, so that's why we haven't sold, and it's still a high conviction idea. So a real eclectic mix, consumer, luxury goods, house building, food manufacturing, and in a way that's we're trying to achieve in the fund, even though it's a concentrated stock portfolio, only 35 stocks, and as a result it will be quite volatile over shorter time periods. But to have a spread of different types of company, different industry, different drivers to the company's performance.
Yeah, well, that's been great, Richard. Thanks.